All right, and if you're just joining us on YouTube for this section, be sure to hit the like, subscribe, and notification button so you make sure that you get notifications whenever we upload a new video or when we're doing live feeds like we do every Tuesday morning at this time. All right, so I told you that on the Secure Act 2.0 that came out right at the end of the year, and this was attached to the spending bill that Congress needed to pass to keep the government working. There's over 100 retirement and financial related changes. So what are the big ones to me? And we're going to talk more about this next week. We're going to devote a whole section of a whole webinar, 30 minutes or so to Secure Act updates. Roth. There's a lot of discussion about Roths, and it's very, very positive. I hear folks often say, well, what if Congress decides to get rid of Roth IRAs? Or what if they decide to tax Roth IRAs? Well, the first thing, we are shown time and time again that Congress doesn't want to get rid of Roth IRAs. And in fact, they want to encourage and require Roth IRA contributions. You might remember that during the first I think I'm remembering it right, during the first iteration of this bill, the Secure Act, it might have even been during the Tax Cuts and Jobs Act, but in previous legislation, there was discussion about requiring the majority of your contributions in your retirement plans to go to a Roth account and limiting the amount that you could put into a traditional 401k. So that's just one example, and Congress wants that money, that tax revenue that's created by doing Roth contributions and Roth conversions. So they like Roth IRAs. Now, the second part of that question, could Congress ever tax Roth IRAs? Well, I guess technically Congress could do whatever they want to do, but nothing has happened like that historically. And if anything, they could say from here on out, we're going to abandon Roth IRAs. And there's no more tax-free growth in accounts. And the folks that have done all the work to save money into Roth IRAs, convert into Roth IRAs, you would be what's called grandfathered in my opinion. Just like what's happened in the past when they've rewritten rules about life insurance policies and taxation of distributions from life insurance policies. So the people who had them before were grandfathered under the old rules, and that's typically how it works. There are new RMD requirements. We're going to talk about that. RMDs are pushed back for some. So that's not everybody. So this is a big point because, we're going to get questions of people who had to take RMDs in 2022 because they turned age 72. And now they read that it's not, it's age 73. So, did I have to take it in 2022? And is there a way to get it back? And, we get these crazy questions from people, but it all starts here and then goes forward. There's no looking back. First of all, I say that because that question actually came up, but very simply, if you were born in 1950 or earlier, there's no changes. There are no changes to your RMD rules. You follow the same rules. If you're born from 1951 to 1958, your required minimum distribution begins at age 73. So your required beginning date is April 1st of the year following the year you turn 73, but they're the same kind of rules. It's just that your age is increased, and it's only for those born from 1951 to 1958. And listen, folks, I say this all the time. Congress doesn't make these rules easier. I thought it was confusing before, and I used to talk about how they make things confusing with ages like 70 and a half and 59 and a half, but my goodness, at least they were constant. Now it's, well, if you were born 1950 or earlier, no changes. If you're born in this 7-year window, well, it's age 73. If you're born after 59, age 59, or excuse me, 1959, your RMDs don't begin until age 75. So this is all great, and it gives a lot of planning flexibility. And as a financial planner, I love that. But it certainly makes our job more challenging as far as educating consumers. It's easier for us to go through and say, these are the rules. This is how it applies. But consumers make mistakes all the time. Institutions make mistakes too. It's not just you folks. It's also the big firms. We see it all the time. So be careful about that. So there are the new RMD rules. Very, very simply. From 1950 or earlier, if you're born in 1950 or earlier, no changes. From 1951 to 1958, your new RMD age is age 73. So if you get a grace period for this year, next year, whatever, hallelujah, good for you. Of course, you can still take the money out if you want to, but you're not required to. If you're born in 1959 or later, your RMD now begins at age 75 under this legislation. So good changes there, but more confusion. The penalty for the missed RMD is reduced from 50%. Remember, the penalty for a missed RMD for many years was 50% of what you should have taken if you didn't take that RMD. So if you were supposed to take $30,000 out as an RMD and you failed to do that, the penalty was technically $15,000. Well, that now is reduced to 25%. So they cut it in half. Well, that's a good thing. And it could also be 10%. So what's the why could it be? There's a phrase that they use, says timely. So if you correct it in a timely manner, then they'll reduce the penalty to 10%. Here's the big secret on this one. Hardly anybody paid that 50% penalty. It would have to be egregious. Most people, if they made a mistake, they didn't take their RMD, they would, if you take your distribution immediately, if you file the correct paperwork, most of the time that fee was waived. Only once in my entire 20-some years now, oh my goodness, 22 years, coming up on 22 years doing this, did I ever see anybody pay a penalty? And frankly, they didn't have to. They just decided that, well, actually their accountant decided that it was the right thing to do. It was the wrong thing to do. They didn't even ask for relief. But in this case, they're reducing the penalty by half and maybe even 10%. But my guess is they're going to be applying it more. So it's going to create more revenue, probably for the Internal Revenue Service and for the country, because I think it's going to be less forgiven. I don't have any numbers to back that up. That's just my thought. It'd be interesting to see, 5 years from now, looking at the RMD penalties compared to what they are in 2028 collectively. So Roth, here we go. RMDs and Roth retirement plans are eliminated. I wish I could do fireworks coming off of here. That's a big one. This has always been an area of frustration and an area of misunderstanding of people. We all know that there are no required minimum distributions from your own Roth IRAs. If you pass them to your heirs, then there are, but we're talking about what you own. Roth IRAs, no RMDs. Roth 401ks, Roth 403bs, there were required minimum distributions. When you turned your age of required minimum distribution, you had to take distributions. Now they weren't taxed, but they still were required. So this is great. It gives more flexibility. You can keep your money in a retirement plan if it makes sense. You can roll it over to a Roth IRA if it makes sense. It's good. But more importantly than anything, it just makes the rules a little more cohesive and a little less confusing for people. So that's a big one. SEP and simple plans can allow Roth contributions. That's another big one. So these are SEP and simple plans are typically for smaller companies. SEPs can be a really good option for just one owner companies, or maybe if it's you and your spouse. Simple plans, in my opinion, are a complete nightmare. They're a pain in the neck to deal with. Nobody should be dealing with simple plans when you can do your own 401ks very easily these days. But they become a little bit better because they can now have Roth contributions where they couldn't in the past. So that's another big one. This is an interesting one. Mandatory. This is why I listed this, because Congress is pushing people now into Roth IRA or Roth 401ks. So there's a mandatory Roth catch-up contribution. So everybody knows that you can, there's a flat amount that you can contribute up to for retirement plans. And then if you're over 50, you can contribute more. Or if you're over 50 and your income is greater than $145,000, you must put that catch-up contribution into your Roth option into your retirement plan. So that's actually going to be interesting as I'm thinking about that, because most retirement plans have a Roth option now, but not all of them. So I wonder if this requirement here is going to force these dinosaur plans that haven't yet adopted a Roth option into adopting a Roth option. So I hadn't thought about that until just now. Employer contributions can now be made into the Roth. In previous years, we've always taught that you can put 100% of your contributions into your Roth plan if you have a plan. I'm talking about retirement plans, 401ks, 403bs, etc. But your employer must contribute to the tax deferred bucket of that retirement plan. Now, the employer contributions can be made to the Roth. So it's probably going to take a little while to figure out the logistics of that. You're, of course, going to have to pay tax on that money where you weren't paying tax before, but it's going to be your money forever, and any growth is going to be tax-free going forward. So that's another big one. For that employer match or the employer contributions can equal a lot of money every year for people. There is another provision to roll over some 529 funds to Roth if you don't need them for college. So one of the drawbacks about 529 plans is that you can use them for a lot of different things, but if you don't use them for higher education, or now even for high school, private schools, things like that, then you're kind of stuck with that money, and you can do things, you can pass it on to the next generation. But now you're also allowed to roll that money into a Roth. Now there are limitations. There are a lot of limitations on this. There are requirements and limitations that you've got to be aware of, but that is a really, really great and freeing topic or a concept for, or allowance, I'll say, for 529s. And it'll probably convince people to invest more into 529 plans. So that's good. Way to go, Congress. What's not included in here? Positives that are not included. I didn't write one thing in here, but the positives from a Roth point of view that's not included is that there are no limitations on Roth conversions. That has not changed. So a lot of people were saying, oh, they're going to get rid of Roth conversions. They're going to put limitations on Roth conversions. And there was discussion about, well, if you earn a certain amount, then you are going to have a limit on conversions. There is no limitation. If you earn $1 billion a year and want to convert $1 billion from your IRA to your Roth IRA, you can do it. So that's good. Little or as much as you'd like. So the second, no elimination of backdoor Roth contributions. So some of us like to do backdoor Roth contributions. And to be very, very careful because of the pro rata rules, but you can contribute a non-deductible contribution into your traditional IRA, immediately can convert it to a Roth IRA. And if you do it right, you don't pay any tax on that. Well, you pay, it's after tax money. You got to be careful. Don't wait too long in between. I'm not going to get into the details, but there's no change, no elimination of the backdoor Roth IRA. And I'll add one negative. So those are both positives, right? So that's a positive. That's a positive. I'll add one negative here. And that is the Roth conversion date. If I could have changed one bit of legislation here, if I could have added something, we all know that you can make contributions to your traditional IRAs or Roth IRAs up to your tax filing deadline, which I think is April 17th of this year. Why in the world can't we do a conversion up till the tax filing deadline? It would make things so much easier because it is a huge guessing game from September. Whenever you do your conversion, it's a huge guessing game. Typically for us, it's September, October, November, December. So that whole end of the year, you're just trying to kind of figure out where people are going to be. And then you have all kinds of, tax reporting that's not in yet. It's just such a bad system. So unfortunately, they didn't change that. That is still 12/31 of the year. So that stinks. So I'm going to start having some serious conversations with my congressman to see if somehow we can start having conversations about putting this into some future legislation. But my goodness, it just seems so simple. I don't even know why they wouldn't do it. More people would convert. They'd convert more money because we often leave a gap for folks just in case. Well, if we can close that gap, that means more tax dollars for people. All right, so that is the webinar for today. We're a little over. It's 10:50. It was great to see you all. I missed you all. I'm happy to see you. If you need anything from us, please reach out. If you need to schedule an appointment, please you can email us at admin@outofourwealth.com or call us at 215-310-9440, and we'll be sure to schedule time for you. If you're a client, you need to see us. If it's something urgent, please reach out to us right away, and we'll get you on the calendar. Great seeing you all, and have a great rest of your week. Take care.